Well, hello everybody. Good afternoon. Hope you can all hear me okay. It's just gone 12 o'clock, Wednesday, 27th of July. So I think we will make a start. My name's Alan Cowie, and I'm from the New Anglia Growth Hub. What we do in 5 words is quite simple: free support for growing businesses. Today we're going to talk a little bit about R&D tax credits or tax relief and how they can be used to grow your business. Before we go any further, I'd quite like just to run a quick poll, if I can. So hopefully you can see that on your screen now. Have you made an R&D tax claim before? Yes or no? Just want to say thank you very much to Barclays for supporting this series of webinars and enabling the technology. So thank you very much. We're very grateful for that. Looks like we've got most of those results in. A couple more people still voting, and so if we close that now and see what we've got. You see the result of that? We've got 75% no, 25% yes. So that's me on the left there looking after things this afternoon. We're aiming for about half an hour, and in order to keep good time, we'd appreciate it if we can save questions until the end. You should be able to see a little hand icon. If you press that, then I can take you off mute and then you can ask your question. You can also type questions into the chat box as well, and if there are any tweeters out there, you can also tweet us at Anglia Hub. Slides are available as well as a handout, little PDF. You can just download that to your work area. So as you can see on the right there, Dr. Morgan Potter, who is our innovation advisor here at the Growth Hub, who's going to be giving this afternoon's presentation. Morgan, I think you said the other day that when you think about R&D, you often conjure up images of men in white coats, but it's not quite like that, is it?
No, it's certainly not that, and I'll come on to that in the slides. It's quite carefully defined by HMRC, which is what we're really interested in this case. Okay, good afternoon everyone. My name is Morgan Potter. I'm the Growth Hub Advisor for Innovation in Norfolk. As Alan said, we offer free support to businesses. And just by way of context, we're peripatetic, which means we're out and about all the time. We actually touch base. There are 10 of us in total, 2 innovation advisors, I should say, 1 for Norfolk, 1 for Suffolk. We've touched, I think we engaged with about 6,000 businesses now over 2 years, which is quite a lot. So as regards my patch, it's basically the A11 from between Bury and Norwich. So that means I work with UEA, Norwich Research Park, Hethel and all the business parks in between, if you like, helping people, giving them business support in any way we can. Generally it's about grants. A lot of companies go from a thought stage to the sort of exploitation stage, but there's a kind of a death valley in between, and we'll promote things like the Innovate UK's grants and Horizon 2020. I've got about 5 companies rooting for that at the minute, but the thing is that these things are competitions, and the success rate is very low. Certainly in the European ones it's around about 6%. So I think there's some work to be done there, and in fact joining up the whole process of innovation is one of the objectives that I would like to see. Coming back to R&D tax credits, this isn't a competition. This is something that people can apply for, and so long as they meet the criteria. Myself, I think it's a poor description of the scheme, because it's really about cash for advances in science and technology, and there are financial incentives available for businesses who are into developing products, innovative products, processes and services. Even if they don't make a profit, they can still claim R&D tax credits. So we're looking for another description for that, so if you can think of one, answers on a postcard. So that's the context. If we just flip to that next slide, what do we mean by SME? because there are a number of schemes. There are a large company scheme, which is now called RDEC, which stands for Research and Expenditure Enterprise Credit. There's an SME scheme as well. So you may think, well, what is the definition of an SME? And the SME definition is a category of a small, micro, small or medium-sized enterprise, SME, made up of companies which employ, enterprises which employ fewer than 250 people. And they have an annual turnover not exceeding 50 million euros and an annual balance sheet not exceeding 43 million euros. But as you can see from the slide, they have relaxed that to make a certainly to bring more SMEs into scope, but really they're outside of the European definition. Which is good for us, because I think the R&D tax scheme is really good, and the only problem is that people just seem reticent to pick it up, but that's where we come in, and possibly you as well. Okay, so what do? We sit in front of people and I have to check out a profile. It's almost like a tick list. I sit there and I think, well, are these people liable? Can they make an R&D tax claim? So we can see from the above, they're supposed to be, they are limited companies, because it's all about relief from paying corporation tax, and if you're not a limited company you won't be paying corporation tax. You've got to be a limited company. You've got to be trading for at least a year, so that precludes startups. You've got to be, as it says above there, you've got to be employing less than 500 people, and your turnover should not exceed 86 million euros. So that's fairly definite. But the fifth thing, it really needs unpacking, which is you've got somebody there telling you this stuff. He'll probably say in a roundabout way, I'm working on something new and different, and I'm sure that competitors will like to get their hands on it. And this is really what needs to be unpacked. So if we move to the next slide. What is R&D? And Alan mentioned people in white coats. Well, it's not necessarily that. And this is really important, this slide. If you take away nothing else, take this away, because this is what R&D looks like from HMRC's perspective. R&D begins, it's time bounded, it begins and ends. It begins with a desire to achieve an advance, and that means it's not really innovation. Again, it's a relaxed form. Innovation talks about something new, never been seen before, talks about market disruption and things like that. The PC is an example of that. We didn't see anything like it before the PC, and now they're everywhere. That's market disruption. But it talks about an advance such that somebody who is a professional in the field would agree that it's an advance. And it talks about resolving scientific uncertainties, and that is a solution which isn't readily deducible or available. And it ends when the advance has been achieved and the uncertainties are resolved. So you can imagine in my project one, you start off with uncertainties, you resolve those uncertainties, and project one ends. So that's the way that HMRC would like to do it. And the 4 rules that HMRC would look at was, first one, has the company taken a risk in the development? Have they gone out of their way, put money into a development and researched it and hopefully got a good solution out, or possibly not, but they've taken a risk? Is there science or technology involved? It's all about advances in science and technology. It's not for commercial reasons. Don't mention the commercial word, because it's science and technology. We've talked about an advance, but again, this is a competent professional in the field. It's not as exhaustive as innovation, I don't think, although people use innovation loosely, but it's an advance. And as are there uncertainties, and I've tried to give you a definition of what uncertainties are, which means that the solution is not available or readily deducible. So, as I said, failed projects still count. But one of the things that a lot of companies don't do, certainly SMEs don't do and should do, is keep records. All of the projects which go into the melting pot, you can go back 2 years, which is different from grants, which are always prospective. These are retrospective. So you must keep records for the past 2 years of all of your retrospective expenses, and these are all sort of added up over the period. So as I say, we can go back 2 years, which means that, for example, if your company year-end date is the 31st of October 2015, and you make a claim before that on the 1st of September, you can go back 2 years. So you can bring in 2012-13 or 2013-2014. Thing is, if you miss that company end date and make your claim after that, you've lost a complete year of claim. So it's very time-bounded, and you've got to make good records of all the expenses that are incurred. Okay, the other thing to remember with R&D tax is that it's all about costs. We know what R&D is, but R&D tax is all about, or tax credits is all about costs. So it's about costs going into a system. And a system in its broadest sense is a collection of components connected in some way. So it really doesn't matter what the system is. So it could be a bakery or a butcher's or anything, but it's all about the costs coming in. So it's not about the profits coming out. That's really the preserve of patent box, which is a lot more difficult to assess, in my view anyway. So you must be in a position to identify all of the relevant costs relative to the R&D activities that have taken place over 2 years. Okay. So as we've said, it's not about men in white coats particularly. It's all about resolving scientific and technological uncertainties. Moreover, as I said, it's not bounded by the system at all, and it could be a system in its broadest sense. But what is really important is that the 4 precepts apply, and I've called the 4 precepts, and I'll say them again because they're so important. Is there science and technology involved? Who takes the risk? Is there an advance such that a competent professional in the field would say, yeah, they've made an advance? And that means an advance in the general area, not just an advance for that particular company. And are there uncertainties which have been overcome? So, yeah, okay. So it could be brewers, as I say, bakers, winch makers, security, but certainly science and technology, but don't mention the commercial word. So there we go, and I sit in front of clients, and I've sat in front of a lot now, and I ask them to tell me about things that you use, or have you created or attempted to create any innovative new products, developing new processes for manufacturing, taken on development projects, created or attempted to create new services or materials. One interesting one is installing and trialling bespoke engineering solutions. We had one a little while back, but the client puts in a specification and the company takes a risk to deliver the project based on the client's specification. And these were bespoke products, every one was bespoke, so the client took a risk every time. So anything that involves installing, trialling bespoke engineering solutions or projects is up for R&D tax, or can be. And quite often clients don't realise, that's the thing, that they're doing R&D, and some of these projects have been the most successful. So as I say, it's, in terms of a business advisor, it's up to us to bring these things to the client's attention, and then we take the appropriate action. Again, just to reiterate, failed projects of the above type are okay. It's okay to fail. That's really one of the hallmarks of innovation. If you don't fail, well, it's very unlikely that people succeed. You can't plan your way to the moon. You can have failed projects all the way. So that's part of the process. Okay, next slide. So what is qualifying expenditure? As I say, it's all about costs going into the system. And what sort of costs are you talking about? We talk about capital expenditure and we talk about revenue. It's not so much capital expenditure, it's more revenue. It's more the day-to-day costs that contribute to the R&D. So I'll ask the client to tell me that. And then we'll talk about the staff costs, the number of people they've got working on R&D and the percentage of time they spend on R&D. And really the R&D qualifying expenditure is a summation of these things, and that's why it's so important for them to keep accurate records. Software licenses, not so much software because these things have got to be consumed, the items got to be consumed in developing whatever product it is. But just flicking back to staffing costs again, we get a lot of software development going on, and it's not so much website design because that really comes under sort of incremental changes, but anybody that's writing software, coders, people like that, are generally doing something behind the product to actually make it do something else. So the coding, software coding is exceptionally relevant. Water, fuel and power, yeah, if you've got a little area, it's hard to assess, I guess, but a little R&D room, you have to work out what percentage of the cost the water, fuel and power are relating to that. It doesn't cover telecoms so much, well, at all, and it doesn't cover services or rent and rates, things like that. You might have to recruit some workers to bring them in. You might generate prototypes, which again get consumed in terms of the overall R&D project. And you might say, oh well, we'll subcontract that bit of R&D work to somebody else because we haven't got the capacity to do it. So you can do that at 65% of the costs. So that's all the good stuff. The stuff that people try to claim for which won't get anywhere were sort of periodic alterations to existing products, as I mentioned, website updates and things like that. Corrective actions in the breakdown of sort of production processes, legal and administrative work associated with patent applications. These are the things which won't go through. Market research, and the more sort of aesthetic and cosmetic enhancements to products. There is the possibility of getting through qualifying indirect activity in R&D processes, again, but the items must be consumed and not still in the original form. I think that just about covers that. Yeah, I mentioned not capital items. I mean, there are things like capital allowances which you can go back to and claim for those. So just to summarise, it's really about revenue expenditure, not so much capital, and things which contribute to the day-to-day running costs. Okay, well, the first part of a claim is a lot of qualitative, well, it's really based on the 4 precepts, which I'll say again. Who takes the risk? Is there science and technology? Is there an advance? And are there uncertainties? That's the qualitative part. You would write a report, or somebody would write a report for you, possibly an expert in R&D tax credits or your accountant under those headings. But then there are the numbers which goes on. There's a qualitative side which goes along with that. And there are 4 scenarios, if you think about it. You go and sit there in front of somebody and you'll think, what sort of profit are they making? Are they making a big profit? Are they making a small profit? Are they making a small loss? Or are they making a big loss? All of those scenarios will result in an R&D tax claim, or can result in an R&D tax claim. So even if you're making a loss, that's okay. One of the things I should say perhaps at this point is is it worth, just a quick summary of the claims themselves, is it worth claiming for this? I mean, is the juice worth the squeeze? Because a lot of times, well, it's worth a comparison. The comparison is this. Going back to the large company scheme, the return, that means the number of pounds you get back for every £100 spent, was on the old company scheme was 6%. Under the RDEC scheme, it's increased a little bit to £8.80, so that if you spend £100, you get back £8.80, which isn't great. But with the SME scheme, you get around about 26%. So that, the juice is worth the squeeze for the SME scheme. It kind of depends where you are in the profit, big profit, small profit, but it's still sizable. So it might be worth, as we've got a few minutes left, just looking at some numbers. So this is the first one, which is a company that's well in profit. So a company that's well in profit might have profits for corporation tax purposes worth £100,000. But they might have added up that list that I showed you earlier and it came to £50,000. They might have had 2 or 3 people working on R&D, each spending 20% of their time, plus all the consumables and stuff like that. It would come to £50,000. HMRC are very kind, and every year they've tended to put up the uplift. They uplift that figure. It used to be about 125%, now it's 130%. So they uplift that 50,000 by 1.3, and it comes to 65,000 if you do the maths. And then they take that off the profit for corporation tax purposes. So they get a new figure of £35,000, which is really good news. So you've actually saved 20% in real terms, in terms of corporation tax, of your £65,000, which is £13,000. So there's been, if you look at £13,000 over the original £50,000, you've saved 26%, which is a godsend to most small companies who probably hadn't even realised they could claim. So that's one scenario. I said there are 4 scenarios, but I don't know if we'll get through 4 scenarios on this call, but anybody who wants to talk further about it can give me a shout later. If we go on to the next slide, that's a company. This is a company that makes a smaller profit. So the company makes £20,000 instead of £50,000, but they've still spent the same amount on R&D. So that gets uplifted by the same amount to £65,000. So the new loss, these guys have now made a loss. They've no longer made a small profit, they made a loss. The new loss for corporation tax is £45,000, 25,000 less 65,000. So what does that mean? What does it mean for them? Well, the first thing it means is they originally had a profit of £20,000, which they don't have to pay corporation tax on. So at 20%, a fifth, that means they've saved £4,000 straight away. Now the rest can be paid in cash, because if you're loss making, you still get the allowance, but it's paid in cash. So it's 14.5% of £45,000, which is total saving, well, which is 6,525. So that makes a total saving of 4,000 plus 6,525, which is £10,525, which is really nice. And in terms of percentages, that'll be 10,525 over £50,000, which is way low, 21%. So again, really worth doing. Definitely worth the effort. Because a lot of these SMEs really are sort of working flat out and haven't got the time, but you can convince them the SME scheme is really worth the effort. Okay, we'll skip the other 2 scenarios, but they are both worthwhile, I can assure you. So that's the small part, the small loss and the big loss. So in terms of in terms of R&D tax credits, I see them as a really important. I think the description is poor. I think well, in innovation itself, it's a hard call in this country, and I've got a whole list of places that I can call on in terms of funding for R&D, but it's still difficult to get hold of generally. Places like Hethel, I was at Hethel earlier in the week, at Life Sciences, particularly at NRP. Again, I've got the H2020 person coming around seeing 4 people of mine from NRP in August, but this is to produce this is a competition, and as I say, the return on, you know, the success rate rather, is very low. So they're going to put a lot of time into a competition where you just have to satisfy the criteria. So in summary then, R&D tax credits are key to funding small businesses in investing in innovation in innovative projects. The thing is, the projects need to be self-funded using their own staff time, and hence the R&D tax credits are very much a part of our portfolio here in the Growth Hub for our portfolio of services that we offer to SMEs. Just a quick note on a couple of advances. As I say, the RDEC scheme is different now. I can go into that if you want, but not on this call. It's a substitute. It came in 1st of April, and it's now instead of the large company scheme. But you're looking for a benefit of around 8%, 8.8%, as opposed to the SME scheme, which is around 26%. So do RDEC, but it's much reduced in terms of its payback. And the other thing which is worth noting, that if you haven't claimed R&D tax credits before, there is something called advance assurance, where you can, these again for companies of less than 50 employees, an annual turnover of 2 million or less. Again, companies who have not claimed R&D tax before, they talk to an HMRC specialist, and they help you in determining if you've got a claim or not. But if you are successful with advance assurance, the first 3 accounting periods they will allow to go through unhindered, and you will not be you'll not be questioned on them because you've done it all up front. So that's 12:27. I guess we're just about done. So yes, Alan will.
Thank you. Yeah, thank you, Morgan. You've kept to time. Fantastic as well. Morgan, probably the first person in history to say HMRC are very kind. But thank you for that. You've certainly helped me and sort of tried to break down and simplify what is on the face of it quite a sort of complex subject. Let's go to questions, and I think Jamie, you had a question which you typed through, so I'm just going to take you off mute. Can you hear me, Jamie?
Yes, I can.
Can you hear Morgan? Okay. Yeah. No, Jamie, off you go.
Yes, it's interesting to note that the revenue have kind of blown hot and cold, but the current flavour seems to be that you can actually claim for the expenses, that's travel, costs and so on, for your staff that are actually doing R&D, but having to go out in the field. But there is a rule, and my understanding and the rule that we apply is that it's only if the person has actually spent the money and then recovered it from the company. You can't claim curiously for expenses associated with credit cards of the company. If your own credit card and you've gone off to see a client to do some development testing and so on, you can recover that now as part of these qualifying costs.
Okay. All right, thanks for that, Jamie.
You're welcome.
Okay. Any other questions? You again just raise your hand and we'll come to you. Stephen Bunting, let's have a look. Are you available, Stephen? Stephen, can you hear me? Stephen? Stephen Bunting, can you hear me okay? No, well, he's typed his question in here, Morgan, which is, what do you think of specialist R&D tax advisors? I suppose really that's a good question, isn't it? So if you think you may have a claim, what's the next step? What should you be doing? Who should you be speaking to?
Well, as I say, I do a first assessment. I have a good idea of what's important. If the claim is small, I would generally say go to your accountant. But if the claim is complex and you can see that it's like to be a large claim, I would talk to a tax advisor.
Right. Okay. Any more questions at all out there? If you do have any other questions at a later date, always pop them through on an email, growthhub@newanglia.co.uk. So unless we have any others, just want to, before we go, just tell you what we've got coming up. Next month, Gary Townley from the Intellectual Property Office will guide you through four areas of IP: copyright, designs, patents and trademarks. Very lively presentation, well worth joining us for that one if you can. In September, Amy Clark of Groundwork, an organisation that can help identify cost savings, will be talking about something called Anglia. So if you're spending a lot of money on heating and lighting, there may be some support through audits and through grants to help put in new technology to help cut bills. And then in October we've got a full business support briefing, really an overview of what the support landscape looks like for growing businesses in Norfolk and Suffolk. So join us for those if you can. Those links are in the PDF, as I said, which is available for you to take away. So that's just about it. Thank you very much to Morgan for that presentation today. Hope to see you on the next one. Thank you very much, and goodbye. Have a good afternoon. Bye-bye.